Welcome to this month's insurance webinar for insurance planning for clients in their 70s. This is the final webinar of the year focusing on clients in a specific age range. Next month, I will be sharing information about annuity reviews as part of your client's insurance planning process. Oh, by the way, this is Jerry. And then in December, we'll be at the end of Sam and Sally's planning, their policies and their lives, discussing beneficiary designations gone wrong, policyholder protection, and real-life client scenarios. Today's presentation will last about 50 minutes. During that time, if you have questions as we go along, feel free to ask them on screen. We'll do our best to answer them in a timely manner. The webinar is being recorded and will be posted to our website within a week. Regarding CFP-CEs, if you are logged into the webinar today for more than 50 minutes using the email address you registered with, we will report your attendance to the CFP board. Now, this process can generally take up to about a month to show up. And this month, Sam and Sally are in their 70s. What if they're in good health? What if their health is deteriorated? And now about your presenter. Mark is a CFP and an MBA who constantly monitors the insurance and financial services industry. Under his leadership, LLIS continues to expand its portfolio of products and services. He's a member of the National Association of Insurance and Financial Advisors and a frequent speaker of NAFA, ACA, Garrett Planning Network, and other organizations seeking insurance-related education. And as of January this year, he is the CEO and president of LLIS. Mark, take it away.
Thanks, Jerry. And for all of those, I see some names on there for of people who were at the NAPFA conference last week in Philadelphia. Thank you for tuning in, and good to see you all last week. And hopefully it stopped raining wherever you are now, but Philadelphia was a little cold and rainy for me. So today we're going to talk about our clients in their 70s. And Sam and Sally, they've been around a long time. And there we go. Sam and Sally have been around a long time, and maybe they have policies that have been around a long time. And then I'm going to talk about sort of this situation where clients, you may have these clients who may not be around a long time. And what are things that we look at that are different when we have clients who are looking at age 95, age 100, and clients whose life expectancy or time frame is much shorter. So first we're going to talk about your clients that have been around a long time. Sam and Sally are now in their 70s, and they got the term life insurance that you'd recommended when they were in their 30s and 40s, maybe even in their 20s. And they're realizing that unlike when they were 30, they were bulletproof, nothing was ever going to happen to them. And now that when you get to 70, Sam and Sally are starting to realize that insurance is real. It is something that I plan to use, and rather than using it as protection against not being able to accumulate enough and sort of an income replacement design, now we're using up our nest egg because we made it. We got to retirement. And so now we're starting to use up our nest eggs, or distribution instead of the accumulation phase. And these clients a lot of times are saying, I want to leave something too. And that can be kids, that can be a charity, usually it's children, family members, but it can be any of those things. And parents are moving the kids from dependency to a legacy. And so for the clients who are in their 70s, they may want to leave that legacy to clients or to children, and life insurance is a great way to do that. Life insurance works well because most of the time someone says, I want to pass on X to Y. X is usually stated in dollars. Now, if you want to pass on a house, you say, I want to pass on the house. But in our experience, and a lot of times with you and you working with your clients, someone says, I want to make sure my kids get X, $250,000, $100,000, $1 million, and why? I want to leave that amount to each of my kids. Maybe it's $250,000 to each of my 3 kids. So the question is, how do you do that? Or how does your client do that? And in actuality, it's not actually your client because in my scenario, your client's dead. But how does the spouse, the surviving spouse, the executor of that will, a survivor, a trustee, how do they pass on X to Y? Well, there's three sort of big picture ways to do it. The first is to sell something. When it's not a house, when it's not a company, you have to sell something to create cash, which is a decision sort of at that time, at death. If there was some planning put into it ahead of time, the client may have said, well, I need to make sure that this amount goes to my kids. So we almost have to put it in cash aside, keep it liquid, keep where there's no risk of principal. So that's sort of an option 2. And then option 3 is life insurance. And I'm going to talk about why I think life insurance is a great way to do it. Sally is 70 years old and preferred, and Sam he's also 70 and he's standard. That's just sort of from my experience about people in their 70s. Usually Sally takes a little bit better care of herself than Sam. Sam usually has a couple extra pounds, and so we're going to have not both of them super preferred plus, but there are quite a few preferred 70-year-olds running around out there. They have 3 kids. They have about a $2 million liquid net worth, and a desire for a legacy is to leave each child $250,000. Now, that's you may have clients who don't have a legacy planning goal or really worry about leaving anything to their kids, and that's fine. But there are a lot of people out there, and this is the baby boomers and all these people who are coming up and are going to be turning 70 soon, are truly put a value on my worth in life as what I leave to someone at my death. And I saw this with my dad's mother, my grandma. She wanted to make sure that she left her kids, who were all grown, who all were successful in their own rights, something when she died, and actually had about a $10,000 whole life insurance policy to do that. But she believed that she needed to leave something. It was a goal of hers to leave something. So for your clients who have this goal, they probably have something in mind that they want to leave to their kids. And so this is a way to do it. Here's this desire. Here's this legacy planning need. So the first way to do something is sell something. Well, in this scenario, Sam dies. Now Sally has to make a decision on what to sell to raise $750,000. What if they own mostly real estate? Where's that cash going to come from? If you had a lot of real estate here in Florida 5 or 6 years ago, you did not want to sell it then. What if it's a closely owned business, especially if Sam was still involved in the day-to-day? What is that business worth right now that Sam, who is still running the show, just dropped dead of a heart attack? What if Sam and Sally ran through their liquid assets? They wanted to leave $250,000 to each child, but they don't have it. That's a problem. And it's going to have to go through probate, which just slows everything down. A second way is to put it aside in cash. And I picked cash because if we say that one of their primary goals is to leave each child $250,000 or $750,000 total, it's got to be put in something that has little to no risk of principal. Because if they ran through all of their money in 3 years because they both needed long-term care and pick any sort of catastrophic scenario, they still wanted to have that $750,000 set aside somewhere. And maybe it is that they run through everything in 10, 15, or 20 years, and not 3 years, but that $750,000, they wanted to make sure that that was going to be there. So it, and at least in my mind, needs to be moved somewhere where we have no risk of principal. It will be there whether they need it tomorrow, 20 years, 40 years. Let's, for sake of argument, say we put it in a money market account. That will still have to go through probate as well. But we've done what we need to do, no risk of principal. It will be there whenever we need it. But if we have clients who are worth $2 million of liquid net worth, and we take 30%, almost 40% of their net worth out of other investment options to create income going forward and put it in cash that we can't touch, that seems to me like a really, like that is really going to hamstring their retirement planning and lifestyle going forward, because they have many more years to go. Let's take that $2 million. We pull $750,000 out, put it in cash. Remainder is $1.25 million. And using 4% withdrawal rate, they have $50,000 a year going forward. I imagine there's all sorts of more scientific and different ways to approach that withdrawal rate, but for the sake of argument, this is, again, simplistic, but makes the point that if they had to take this out, they're not really able to live on that full $2 million. Now, a third option is a no-lapse guarantee survivorship universal life policy for $750,000. Now, there's a lot that went on in that one bullet right there. So this is a no-lapse guarantee, meaning that for today's single premium of $204,185, it guarantees a $750,000 death benefit at the second death, so meaning Sam, or once Sally and Sam are both deceased, $750,000 is guaranteed for their lifetimes to their beneficiaries whenever they die for that one single premium. So if we take, instead of, let's take the $204,000, take it out of our $2 million pie chart here. We've sectioned off $204,000. We've created the $750,000 death benefit. So I've satisfied that legacy goal to provide each of my kids $750,000, or each of my kids $250,000. So I'm taking that out. So I've satisfied that need. Now I truly can live on all of the rest of that, almost $1.8 million. The client's goal may be, I'm going to use up the $1.8 million, and I want the last check I write to bounce. I've used up every penny of it. But you know what? I still know that my kids are going to get $250,000 each. And that's a way to do that. And look at that withdrawal rate, $50,000 compared to almost $72,000. So we've been able to do essentially the same thing, have that same safety of of providing that legacy without taking so much out of population, if you will, in their investment portfolio. Why does the guaranteed universal life policy, in this case survivorship, work? Well, it's simple. There's a single premium, guaranteed death benefit for as long as they live. When they die, beneficiaries get X. It's a guaranteed legacy. That's a no-lapse guarantee policy. All of that is contractually guaranteed, not based on dividend assumptions or interest rate projections. The no-lapse guarantees that make that work. Passes by contract. So we have named beneficiaries. That's neat because, A, it passes outside of probate. So at the second death, the money can go on to the kids quickly, free of probate. The other thing that's nice is that you can change the beneficiaries easily and free. I haven't, I created a will a little while ago, and at some point I'll probably need to update it, but I'm going to need to call an attorney, pay attorney's fees, do a lot of different things to update a will. But if I wanted to change the beneficiaries on my life insurance contract, well, I just call Neva Clark here. I wouldn't call her, I just walk over. But I walk over to Neva and say, I need to change my beneficiary. She gives me a form, I fill it out, send it to the insurance company. No attorneys involved, no charges. So that's one really nice thing about this legacy planning that life insurance can do that going through the estate many times creates some extra layers. As I said, Sam and Sally can use all the other assets. That last check they write can bounce and know that the kids each will get that $250,000. And of course, if there's money left over, the kids will share that, but we've created a floor that they know they will, they will get some sort of minimum. Life insurance can also be used to equalize. Let's say one of the kids was caring for Sam and Sally later in life, and they want to leave that child a house. They could say, okay, well, Susie gets the house, and so we're going to make Fritz and Hank the 50% beneficiaries of the $750,000 policy. So it's flexible, but we can use it also to equalize. Cash is a great equalizer. And I know a number of you are probably thinking, well, what if we took that $204,000, I didn't put it in a SOC or in a money market account, and I had it to grow? Well, let's go with that's an option. And if you had the $204,000 and it grew every year without fail at exactly 5% on a net after-tax basis, you're right. Eventually, that $204,000 would grow to more than $750,000. But as you can see on my chart, it's about age 96 or 97. So, as legacy planning, the life insurance wins for the next 27 years. And some of you out there might have clients that live to 100, or you even expect yourselves to live to 100. I am not making any plans for my 97th birthday right now. So to have the life insurance win for what's reasonably life expectancy plus even a handful of years, it's really impressive as a way to make sure I've guaranteed that legacy. In the early years, the difference is remarkable. Sure, we have enough time, those assets will grow, but that, like I said, through their 70s, through their 80s, even most of through their 90s, the life insurance wins. So those are our clients who have been around a long time. Now what about your clients who have come to you, and they have policies that have been around a long time? Well, this was a case and something I was working on here recently. And Sam, who's the nephew, we're moving not from Sam and Sally, their own planning, but Sam's a nephew of his uncle, well, by definition. But he's the trust beneficiary and a client of an advisor. And so he's a beneficiary of a life insurance policy. The trust company and Sam came to the advisor and said, what should we do about this policy? And then the advisor came to me and asked, what should they do? And so this will be a little bit clearer here in just a second. So Sam is a nephew, and he's the beneficiary of a trust that holds a life insurance policy on his Uncle Steve. Now, Steve is age 84, and it's a $1.9 million universal life policy issued in 1999 when Steve was age 69, and he was a preferred non-smoker. So Sam, being the trust beneficiary, is wondering about this policy. How is this policy performing today? What are my options for this policy that Uncle Steve set up for me for my benefit? And today, the cash surrender value of the policy is $672,000. It has a cost basis of $766,000, meaning that there's no gain in the policy. Uncle Steve is not paying any more premiums. And under the current assumptions, the policy lapses in approximately 4 years at Uncle Steve's age 88. So do we stay or do we go? And the million-dollar question, well, in this case, it's actually a $1.9 million question, is how long is Uncle Steve going to live? So while we can't know that for sure, we have a better idea than the insurance company does today. And we have a better idea than in 1999. Because in 1999, he was healthy. He was a preferred non-smoker. Health can change in 14 years, especially going from age 69 to 84. So we aren't just evaluating this in a bubble, assuming that he's still a preferred male non-smoker. We know how how his health is today. And so we can evaluate whether do we stay or do we go using all the information we have today. So option one, we stay. Option one is actually don't do anything. Uncle Steve dies in 4 years, no more premiums were paid, and Sam gets $1.9 million. Anybody see the problem with that? Well, what if he doesn't die in 4 years? So maybe not the best option. Surrender, so we go. Don't keep the policy. The trust surrenders the policy. Sam gets $672,000 through the trust because the cost basis or sum of premiums paid is $766. There's no gain on the cash values, so there are no income taxes on the proceeds. So Sam gets $672,000 income tax-free. But he loses out on $1.2 million of future income, tax-free death benefits. It's not future income, it's future income tax-free death benefits. Why do I say he loses out? Well, if they kept the policy in force, he'd get $1.9 million tax-free. If he surrenders it, he gets $672,000 income tax-free. So let's say that Uncle Steve's not in good health, but 4 to 5 years is cutting it kind of close. I know his health's not great. You know, he is 84. But do I think he's not going to make it, or Sam's saying, do I think he's not going to make it 4 more years? Well, they do have an option to pay a small premium going forward. So maybe it's starting to pay something every month or every year, just covering the cost of insurance from year to year. And as of now, Sam has paid nothing. So his rate of return on a small premium to get that extra $1.228 million is really, really impressive. Now, to explain sort of what I mean there, his net present value of that policy, if he surrenders it, is $672,000. The future value is $1.9 million. So on one hand, I can take $672,000 today, income tax-free, or I wait and get $1.9 million income tax-free. So what's Sam's rate of return on premiums paid? Well, depends on what premiums are required, the length of time Uncle Steve lives, and then based on those two things, so you have payment, you have N, which is the number of payments. We're going to solve for I, and then our future value is the $1.228 million. And I'm going to talk about that here in a little bit. Well, what if Uncle Steve's in good health? We still have the option of number one. We still do nothing. And if Uncle Steve passes away in the next 4 to 5 years, Sam gets $1.9 million income tax-free. Nothing's changed. But if Uncle Steve lives 6 more years, well then there's 0 death benefit. There's 0 cash values without the trust or somebody having to pay very, very large premiums. Premiums on a $1.9 million policy on what will then be an 88 or 89-year-old, tens of thousands of dollars each year. So this is the highest risk-reward option. To Sam, I don't pay anything, and you know, if he dies in the next 4 years, I get $1.9 million. But the flip side is if he's healthy and lives a little bit longer, well, then he gets nothing. So to me, I wouldn't play that option. But you know, I was at the NAPA conference in Paris and Las Vegas. Spent very little time in the casino. Played a little war, which I didn't know you could play, but that's that was my risk reward for that, and it was the lowest dollar table I could find. So, Uncle Steve's in good health. We still have the option to surrender the policy, and this is sort of, you know, it's still an option whether he's in good health, not in good health. Oh, I had somebody ask a question, why is the cash value so low after holding the policy for 14 years? Seems like it should be more. Because he was older, it's a large policy. The total premiums paid in were only $766, and so over the course of time, the cost of insurance whittled down the policy. That's there are costs of insurance to a policy, and I don't know. I knew the cost basis of the policy, so I know the sum of premiums paid. I don't know what premiums or how many years he paid in those premiums. So this is our option 2. Our option 2 is still surrender. Stem still gets the $672,000, pays no income taxes. So whether Uncle Steve's in good health or not in good health, this is an option, and I call this sort of the lowest risk option. Not holding it for longer, not possibly paying premium or writing it out, but it's still an option. Just taking the money and running. So option 3, he keeps the $1.9 million. We start paying premiums, and premiums to carry to his age 95 are $109,000 a year. To carry to his age 100, $144,000 each year. So what are issues with this? Well, he has to wait. He has to be able to write a $109,000 check, so some people may not be able to do that. We still have some risk of Uncle Steve's longevity. Hey, Uncle Steve's 80, 84, and he's still in great health. Maybe he lives to 101. But I touched on this, and so how do we figure the rate of return on the premiums? Well, the rate of return on the premiums, if Uncle Steve lives to age 95 for the difference, remember, I can get the $672, so the trust is paying $109,000 to get 1.9. I pay $109,000 to his age 95 to get the 1.3. The rate of return at age 95 is is less than 0.5%. If Uncle Steve lives to 100, well, then somebody paid $143,000 to get the 1.228, and you have a negative rate of return. So these are things that we look at. How long do we think he's going to live? If we're thinking about age 95, almost exactly the same whether you surrender it for $672,000 today or pay that $109,000 each year to get the total of 1.9. But we're saying that Uncle Steve is actually a healthy 84-year-old. Well, he's not preferred anymore, but he's standard. The standard 84-year-old could apply to a new insurance company, and this is the things in the bold. With the cash values rolled over to a new company and a $1.9 million policy, a premium of $63,400 would carry the 1.9 to his age 95 with a new company. So we're keeping the same design, but not staying with the same insurance company. But we still have to wait, and we still have some risk of Uncle Steve's longevity. We go with an age 95 assumption, and he lives to 96 or 97. We have to pay premiums for a few more years. But look at this rate of return. 672 is what I have in one pocket. I can take that today. Or I pay $63,000 to Uncle Steve's age 95, assuming he dies at age 95, then I get an additional $1.228 million income tax-free. That's almost an 11% income tax-free net rate of return on the premiums I've paid over, 95, so age 84, so over 11 years to get the 1.228. So that's interesting. That's something that would make you say, well, let's look at this. Maybe we don't just surrender it. Again, Uncle Steve's in super great health. Nobody's ever seen anybody who's as healthy as Uncle Steve. He's going to live to age 100. It's again, negative 2% going forward. So just things to consider. Why I've been talking about all this is if he's in good health or bad health, these are all things to take into consideration. Option 4, well, we have the option to just reduce the face amount. Let's say we don't want to pay premiums, but I understand, let's reduce the face amount. I'll get, Sam says, I'll get more in the future. I don't want to take the cash values, but let's reduce the face amount going forward so it's more likely that it'll be there in the future. So we could reduce the face amount from 1.9 to $1 million, or reduce it down to 825. The 1.1 million and 54 carries to age 95. So the longer we need it to last, the more we need to reduce the policy without paying some premium. We have a higher benefit than surrendering. Still have to wait. And it's life insurance, so we have to wait until Uncle Steve's deceased, and we still have some risk of Uncle Steve's longevity. Or we apply it to a new company. Same idea. What is another insurance company's reduced face amount using the same cash values and a standard male age 84? Well, 1.173 or 973. So still more than staying in the existing policy. But again, still have to wait, and still some risk on how long Uncle Steve's going to live. So all of these are options. All are things to consider, and things that when your clients come to you with, what should I do with this policy? These are all things that we might throw at you. But the overriding factor of almost all of these is the client in good health or not in good health? Not in good health, then we have to stay and work with these 3 or 4 options. He's in good health, well, we can stay or maybe look at other options. So, but in any situation, you're going to have the roll the dice, no more premiums. 4 years, 1.9 million, no premiums. Let's see what happens. Go on, take the money and run. Steve Miller reference. I'm going to take that 672 and say thank you, Uncle Steve, and maybe I'll take him out to dinner or something. We can reduce the death benefit down so that we don't have to pay premiums. We can pay premiums and keep the full death benefit. Sometimes call this, you either raise the bridge or lower the river. I have X amount of cash values, and so that's a fixed assumption. I either have more life insurance and pay premium, or less life insurance and don't pay premiums. Both are good options. It just depends on what fits. And if Uncle Steve's in good health, willing to do it, you can apply for the new policy and maybe even do all of those, but more efficiently than inside the existing policy. And there's all of our stay, go, stay, go. So policy reviews are critical, and this is, again, really what I just did here was a big policy review, multiple emails back and forth with the client, the advisor. If someone's not in good health, then other things we might look at are, if a policy has a policy loan, pay off the loans. Usually a policy loan interest is at X%, and crediting interest rate on cash values and the loan balance are at Y%. There's usually a spread there. And so when you have a policy loan growing at a higher percentage than the base cash values, call it a snowball rolling downhill. Eventually the policy might lapse, or the client has a reducing death benefit every year. So one option is to pay off the loan balance, bring the death benefit back up. If it's a whole life policy and someone's in pretty poor health, they've been using the dividends to reduce premiums, so either they have no out-of-pocket premiums or maybe they're paying a reduced annual premium. One option is to change the dividend option to purchase paid-up additions. So yes, they will have to start paying premiums again, and maybe it was a $2,000 annual premium, and now they're paying $100 or $150. It will go back up to the $2,000. But why this is valuable is that dividends purchase paid-up additions. Paid-up additions are essentially a tiny single-pay whole life policy. But dividend and paid-up additions will always have a factor larger than 1-to-1 on premiums paid. So what that means If I have a dividend of $2,000, I know that my death benefit increase will always be greater than $2,000. It might be $3,000, it might be $4,000, but some factor. So if the goal is to provide a legacy or increase my life insurance because maybe I'm not in good health, I'm starting to pay the $2,000 annual premium, but my $2,000 dividend is buying $4,000 of life insurance. So net, I'm increasing my life insurance amount of coverage. And so what about for your clients who may not be around a long time? We're going to talk here about term conversions. For most of your clients, when they were younger, they had a life insurance need because we were worried about income replacement. They had kids, they had a mortgage, they had debt. And so all of these things happen where, what if I pass away before I'm able to earn my income, save for college, get my kids out of the house? And hopefully by this time, all of that's been satisfied, but your client still has their term policies, whether because they bought it when they were 20 and it's just a really low premium and they decided to keep it, or it might be nice to finish paying off a mortgage, or just in case maybe not, I'm still part-time at 67 and so I want to go ahead and keep some insurance. But your client has an existing term policy and they're getting to Sam and Sally's age 70. Surprise, surprise. But most term policies allow conversion, and all the ones that we recommend are going to have a conversion privilege that extends to the end of the level term period, not to exceed some maximum age. The most common age is age 70. So for a client who's 30 and bought a 20-year term policy, that policy will be convertible for all 20 years. They were 30, 50, so all full 20 years. If they're 60 and bought a 20-year term policy, then they may only have a conversion option for 10 years based on the most common the conversion expirations. But what are the things when your client has a term policy, and why is conversion attractive? Or what are things that they're thinking when they ask you about their term policies and keeping some coverage? Well, their needs changed. When they were 50, they bought the 20-year term, and they thought everything would be all hunky-dory by the time they got to age 70. But maybe they still need some insurance longer than age 70, a little longer than 20 years. And maybe their health isn't as good, and maybe couldn't qualify for as good of a rate as they did when they purchased a term policy. Maybe they have this change from income replacement to estate planning or legacy, like I talked about earlier. I'm not worried about earning my income or building up my nest egg. Right now I'm worried about using up all of my nest egg and not leaving anything to my kids. It's emotional. For many of your clients, they've had term life insurance for 30 years, and now that they get to the age where they actually are thinking that they might actually need it, now they say, well, I've always had life insurance, and I thought I'd always have some. It may not be the full $1 million term policy that they originally purchased. But as advisors, you can guide the client through these conversations when they're coming to the end of their term periods or coming to the end of the conversion periods. So what is conversion? I said, talked about a little bit and what the needs might be, but what is it really? A conversion privilege allows your client to exchange a term life insurance policy for a permanent life insurance policy. So I have a 20-year term policy, and I'm essentially trading that term policy for a permanent life insurance policy. Why conversions are interesting? There are no medical or financial underwriting questions, questionnaires, anything done. So if your client has a preferred plus rate class when that policy was issued 20 years ago, the new universal life policy will be issued at a preferred rate class. That's why this is attractive for people who have had health changes since they got their existing term policy. The new policy is based on their attained age. So I was 50 when I purchased my 20-year term policy. I convert at age 70. I keep my same rate class that my term was issued at, and my premiums are based on my now age 70. You don't have to convert all of the term coverage. I needed $1 million when I was working and I had a good income. Now that I'm 70, I don't really have a desire to pass all $1 million on to my kids. But I have 2 kids, and maybe I'd like to leave them $250,000 like in my previous example. And so maybe $500,000 of coverage would be good. And I've had a couple heart things since I got that term policy. Conversation Sam is having in his head. So you can convert some or all of the term policy. All $1 million, just $500,000, maybe even just $250,000 or $100,000. If the conversion option expires before the end of the term period, you can convert some portion of the coverage and keep the remainder as term. I'm going to say that another way. Let's say I have that $1 million of term coverage. I bought it at age 62. And so at age 70, my term conversion is coming up. I convert $500,000 of coverage. I can keep the remaining $500,000 as term to my age 82. So if it was a 20-year term policy, I can convert some at age 70. That's permanent. And then the remaining $500,000, I can keep that as term to the end of the term period. So for most clients with term coverage, age 70 is go time for this conversion decision. It may not be exactly when they want to make it based on their life and everything that's going on, but for most clients, either they've had to make the decision when the term period was coming up, or it's age 70. So what is needed to convert? I have one question. Can you also convert annual renewable term? Possibly. It just depends on the definition in the policy. Annual renewable term, whoever issued it is going to have listed in the policy their conversion date. It might be 10 years. It might be age 70. So good question. With guaranteed level term, it's pretty easy to figure out. It's through the end of the term period, not to exceed some age. Annual renewable term, we'll need to either check with the insurance company home office, or it will be listed in the policy. So what's needed to convert a term policy? Pretty much 3 things. Signed conversion form, maybe a page, maybe 2 pages. A signed illustration. Illustration 7 or 8 pages, but client has to sign and date. A premium check. This is about as there's nothing else in the insurance world that's as easy as this. Trust me. No medical underwriting, no medical questions, no paramed exam. All these other things. It's very simple, and it's based on that preferred rate that your client got 20 years ago. So is conversion always the best option? Well, the answer is no, it's not always the best option. Sam just turned 70. He has a $500,000 first colony Genworth term policy. It was issued at a preferred non-smoker rate 10 years ago. The annual premium on this term plan is $18.85. The conversion and term expiration date is 10/26/2013. And the $1 million question, actually in this case it's a $500,000 question, is he healthy? And just so you know, these dates seem very specific because this is one of your clients that we're working on converting their term policy. So that's why I have all these numbers. 10/26/2013 seems pretty specific. Well, that's actually all of his information. Names have been changed to protect the innocent. So let's say he's healthy. He was preferred 10 years ago. Let's say he's still preferred. Well, what does it cost to convert the Genworth term policy? A conversion illustration based on his preferred non-smoker rate class and a premium solved for $500,000 coverage to his age 100 is $15,730 a year. No questions, no medical exam, no medical records, just those three things: a 2-page form, a signed illustration, and a check. So that conversion UL costs $15,730 at a preferred non-smoker rate class. If he's healthy and could possibly qualify for a preferred rate with any company out there, it actually makes sense for him to look at other policies. If he's preferred annual premium for a comparable policy and design, $13,000. That's $12,900, but $13,000 a year. So if he's still in preferred health, then it makes sense to look around and sort of shop the universe of insurance companies to see if the conversion option is still the best that's out there. But notice that if he's not preferred again, he's not preferred still anymore, but maybe a standard plus or standard, all the other options out there are in the $16,000 plus. So that's sort of the value of this. If he's still a preferred, it's better than, his premium is lower than applying somewhere else and not qualifying for that preferred rate class. If he's still preferred, though, and we can look at the universe of companies, very likely we can find a lower premium for him. But the actual scenario is that the advisor called us and wanted to look at his conversion because he's told us that Sam has a terminal illness and probably has just a few years left. So the first thing we looked at, because we'd done some original conversion illustrations to the age 100, and depending on if he's still preferred, these are what the numbers are. I would say we really have no reason to look at age 100 premiums. Our time frame is very short. I even looked at having them just pay monthly premiums, so they're not writing a larger check for the full year, just paying on a monthly, as-you-go basis. So I looked at 2 premium solutions for them. One, if we just guaranteed the coverage, $500,000 for just the next 5 years. Well, that number was $542 a month, or $6,504 annually. Or if we guaranteed it just the next 10 years, so a little more, a little more cushion, a little more leeway, $686 a month, and that's $8,200 a year. Now, Sam, with everything he's going through, I have no doubt he has some added medical expenses, and I'm just not even sure what all they might be doing. But the 542 or 686 may not be easy to come up with each month. But this is where you as the advisor can add a lot of benefit, because what is the value of this policy today to the spouse or children or the beneficiaries, all those people probably the beneficiaries, to find a way to do the $542 a month or $686 a month. Now remember, this will be a cash outflow, and he has terminal cancer. So they're depleting some of their other things they thought they'd use later for the medical bills. But the life insurance can replenish this nest egg, and let me show you why I say when you can counsel them through it, this is where it makes sense. The rate of return on the 5-year premiums. We convert the policy. Sam dies in the next year. Regardless of which option he paid, they pay $5,000, $6,000, $7,000, $8,000 and get $500,000 income tax free. The rate of return is in the thousands. Let's not worry about the first year, but let's talk about 5 years out. On the short term, he has the 5-year. To pay those premiums for 5 years, the rate of return is over 100%. That's compounded every year. So where that $5,000, $6,000, $8,000 may not be easy to come up with, it's going to replenish that nest egg. It's going to replenish all those premiums, and more so, and with fantastic numbers. on the 10-year. They pay the premiums and Sam lasts for 10 years and dies. It's still a 32% income tax-free rate. So that's 32% net after tax. Don't know where they're going to earn better than that anywhere legally. So these are the things where you as the advisor can counsel them. This is not easy. This is not hard. This is not easy to come up with this premium. But it's going to be able to replenish what you're spending, and sort of you get a my kids love Monopoly, so you sort of get a go straight to go, collect $200, sort of a redo on all that money that's going out. It just comes back in and replenishes that bucket. But we have a secret weapon. Or we're talking about conversion. Is conversion the best option? We know the client's current health, and we can arbitrage that against the conversion option that comes without the underwriting questions. If Sam's still in good health, he's still a preferred, we don't have to take the conversion. We can see if he can get preferred somewhere else and save $2,000 or $3,000 a year. In this case, where we're concerned about a 5 or 10-year life expectancy, not preferred. We're arbitraging the rates based on a preferred non-smoker for someone who has a very short life expectancy. So the ability to do what we can do, this is that arbitrage. This is our secret weapon. And you have a secret weapon. Many of you may not even know that it's available to you. We here at Low Load Insurance Services have our NOTE program, or Notification of Term Expiration. So for any of the policies that LLIS has helped your clients purchase in the past, we have in our proprietary database. We keep track of the term expiration date, and we also keep track of the conversion expiration date. So you and the clients are notified well in advance of either the term expiring or the conversion expiring, so that we can make sure that we have we can look at all the options available. If your client's still in good health and they want new coverage, new term, permanent coverage, and they're still preferred, we can go out there and shop the universe of companies. Your client is like Sam in this situation. This conversion option is amazingly valuable to his family, who doesn't want to lose Sam, but we have the ability to replenish that nest egg, replenish all those costs paid out with life insurance based on a preferred non-smoker rate for someone who has a short life expectancy. And why I say you have a secret weapon is that if you have any clients with term policies and you know they've had health changes, feel free to let us know about those policies, and we can keep track of those policies for you. We'll send you a notice that says, Mr. Client, Mrs. Client, you asked us to follow up with you on your client's 20-year term policy, and we noticed that the conversion expiration date is coming up in 4 or 5 months. Maybe, again, the secret weapon is that they've had heart issues, but we reviewed a term policy and it was a super preferred rate. So things that we can help you with to make sure that we do everything that we can to make sure the policies that we helped your clients with not fall through the cracks, not have any of these things happen. But if you have other clients with policies who you want to make sure that they don't fall through the cracks either, let us know and we can add those policies into our own system. So we talked about your clients who have been around a long time, talked about what to look at for policies that have been around a long time, and things to talk about when, unfortunately, your clients may not be around a long time and what options they have available. As Jerry mentioned at the beginning, Jerry will be talking in November about our at one of our webinars for annuity reviews, and then in December, Judith and I will be talking about the end of the year, the end of insurance planning, of the policy of life, real life situations. We're going to talk about beneficiary designations and why those are important, what to do about the policy holder protection. And if anyone is on paying attention who hasn't used us before, isn't familiar with us, this is one of the things that makes low-load insurance services different from probably anybody else that you've used before to assist your clients with insurance. We do a free monthly webinar for all of our advisors. Additionally, we're not your competition. Our only clients are fee-only advisors. We do a lot of pre-underwriting to avoid surprises. We save you time by reviewing your clients' policies, and we save your clients money by using low-load policies where available and the pre-underwriting below to find clients the best policies that they'll qualify for. We provide advisor education. There's a number of excellent things on our LLIS.com website, like advisor tools. We have the Low-Load Insurance Services Insurance Academy in February here in Tampa. And so for all of you who are of the northern climates, feel free to register for 2 days of fun and insurance and warm weather. And we proudly sponsor NAPFA, the Garrett Planning Network, the Alliance of Cambridge Advisors. In fact, as I mentioned, I just returned from the Philadelphia NAPFA conference, and Jerry and I will be at the ACA conference in Arizona just in like 3 weeks. I can't believe it's already 3 weeks. We're also a proud sponsor of the NAPFA Genesis Group, helping the younger fee-only advisors learn about the industry and things that we can do to assist them. And we have product specialists in the life, disability, long-term care, and annuity arenas. We're all salaried employees here at Low-Load Insurance Services. When your clients get insurance through us, we keep you as the advisor up to date with our AIM system, and this is an application information message. So when you refer clients to us, they're not just sent off into a black hole and you never hear anything about your clients again. You're kept up to date to when an application has been submitted, when a policy has been issued. And so this is one thing that allows us or allows you to integrate us into your financial planning practice. And we manage your clients' policies now and in the future. We talked about the conversion, the notification of term expiration being sort of the end of the policy, but we're monitoring them through the course of time with the advanced premium email and letting your clients know soon that when a premium is going to be due. It's just a reminder and a friendly notice to make sure that policies don't fall through the cracks when it's time to send in their annual premium. And I had a couple questions come through. Let me go back here. One of the questions was, how healthy do they have to be to qualify for the survivorship policies? Really no different than anybody else. When you're 70 or 75 or 80, there are still some criteria that you get benefits from, like when you're younger, most insurance companies use family history of heart disease or cancer. When you get to be in your 70s, most insurance companies say, we aren't going to worry about that because you're already 70. You've outlived our concerns about an early death from heart disease or cancer because you're already age 70. But for the most part, I call the female a preferred, and there is a number of companies who offer a preferred plus rate at age 70, and the male is standard. And so those are pretty common and really not unheard of. You can even have one client be uninsurable for a second-to-die policy. And we've had that happen before, where by using a second-to-die policy, where one spouse is healthy and insurable and the other is not insurable, a second-to-die policy still performs better than just an individual policy on just the one healthy person. Let me scroll through a couple of these. All right. Well, I have one or two other questions that I need to do a little bit of research on, and I will follow up with those later this week. But it is 5 o'clock. Thank you to all of you for listening, And Jerry will see you next week, and then next month on the webinar, and then I will see you all in December. So thank you very much.